At this time, I want to go ahead and announce our keynote speaker. I'm going to make it short and make it brief. Mark Pinsky is the President and CEO of the Opportunity Finance Network. And OFN is a national network of more than 200 high-performing community development financial institutions investing in opportunities that benefit low-income, low-wealth, and other disadvantaged people and communities across the nation. Please welcome Mark Pinsky.
Thank you. Good morning, everybody. And thank you, Ron, for that introduction. Thank you, all of the partners and sponsors and everybody who made it possible for you all to be together and for me to join you from Philadelphia. And I didn't plan, I'm already off my planned notes because Ron's story made me realize I had to tell a story that has a St. Louis tie because my wife is from St. Louis. And it's a story about how I got into this job. I've been doing this job for about 25 years and never expected to be in this job at all. But one day in 1989, my wife got a call from her best friend from high school here in St. Louis, who was in Philadelphia with his girlfriend, whose sister was married to a guy who had just started this organization, and he thought that maybe we'd like them. And so I got my career start, really, in the thing that I've done for my life and hope to do for the rest of my life, because my wife's best friend from high school, sister's husband, was doing something really interesting. And so, Rob, where'd Rob go? Rob, there you are. Rob, you and I were talking last night about how much of what happens in life is really about serendipity and unexpected things. And so I think being prepared to sort of expect the unexpected is always a great thing. And Ron, thank you for the introduction. My organization is celebrating its 30th anniversary this year, and I'll tell you a little bit about us in a second. We are a national network of organizations like Justine Peterson, who's part of this event, and we work in all 50 states in urban, rural, and native communities. But because it's our 30th anniversary, and we have a big conference coming together in a couple of months, I've been spending a lot of time thinking about 30 years, what 30 years means and what's happened and what shaped us and what serendipitous things happened and who we met on a bus and all that sort of stuff. And when we first came together, it was in Waltham, Massachusetts. It was in a converted convent. There were about 40 people in the room. They were all out there trying to figure out how to lend money to people that didn't seem to be able to get access to capital or access to credit in any other way. Together, when they counted it up, they had about $27 million, which seemed like a whole lot of money, and it is a whole lot of money. But they didn't know a lot. First of all, they didn't know what they were doing, which was probably a good thing, because if they had understood the rules of credit or the rules of lending, they never would have done the things that they did. For example, they never understood that it's actually good to have equity on your balance sheet, that might protect your investors in some way. But they also didn't know a lot of what was going to happen because they were sitting in that room together. They were actually sitting outside under apple trees, but that sounds that sounds like I'm stretching the truth. But and so they didn't know that they were, for example, at the time they were all doing affordable housing lending, community land trusts and things like that. And they didn't know that someday that they would get into small business lending, and that 25 years later that they would become sort of major players in small business lending in this country. And they didn't know that they were going to become, out of that little group of folks, were going to become the sort of leading financiers of charter school financing in this country. And for many years, CDFIs, if you think about it, who wants to make a 30-year, non-amortizing loan on a 3-year charter, when the risk that the charter's not going to get renewed is the risk of your loan, right? So things like that. So who knew that they were going to be able to do that? Who knew that they were going to start a movement in financing healthy foods in this country? Who knew that they would prompt things to happen at state, local, and federal governments, that there would be, within 10 years of that meeting, there would be the creation of something called the Cdfi Fund, which is a very unique program at in the federal government that is the only program, to my knowledge, with one exception, which I'll tell you about in a second, that makes equity investments in financial intermediaries rather than project-based financing. So it's not financing it's financing the intermediary to use its entrepreneurial skills and its market knowledge and its market expertise. So who knew that we would invent a new way of exercising fiscal policy in this country that would give tremendous leverage and bang for the buck, that would encourage partnerships between CDFIs and banks and CDFIs and communities, and it would change the way we thought about community development in this country. And by the way, the only other program that's made equity investments in financial institutions was the TARP program, which actually looked at the Cdfi Fund program. We don't like to make that association, but it's there, and we got to live with it. Who knew that we would, for example, with the SBA, that a courageous administrator named Karen Mills would push the limits of what the statute said to create a program called the 7A Community Advantage Program that would allow non-depository CDFIs to participate in the 7A Guarantee Program, which has been so important to small business lending and to small businesses in this country for all these years, and that would open the door to a new approach and new ways of partnering between banks, and it's happening on the national level in a big way. We had no idea of that. We had no idea, although we had always dreamed of this, that we would gain access as non-depositories to the Federal Home Loan Bank system. And I can tell you that when Congress passed a law in 2008 that gave non-depository CDFIs, non-bank, non-credit union CDFIs, the ability to apply for membership in the Federal Home Loan Banks, I and some others sat down with the presidents of the 12 Federal Home Loan Banks, and to a person they all said, there's no way we're ever going to let you in, and there's no way we're going to ever lend you money. And the only thing we could say, because it was true for us, was, that's what everybody tells us when we start out, but we're going to become members and we're going to borrow from you, and we are doing that now. It's a movement that's picking up tremendous speed, and it's making a difference in the markets where we work and where the Federal Home Loan Banks are trying to serve. Who knew that as part of when there was frustration over the Housing Resolution Fund and there was frustration over the lack of small businesses getting access to financing, that the Congress would pass something called the Small Business Loan Fund that would provide long-term credit to CDFIs, or that there would be something called the Cdfi Bond Guarantee Program, which is a new program that uses a federal guarantee to leverage long-term money for CDFIs, a kind of money we've never had that we're still trying to make work, but when we make work is going to flip some of the relationships. CDFIs started out doing short-term lending, not always sure where the takeout finance, doing pre-construction lending, for example, for housing deals, or doing early-stage money, counting on the banks to come in after them. And with the Cdfi Bond Guarantee Program, banks, which love to lend, they love to find ways to do it, but they have to manage their risk because they have regulators looking at them, and they should manage their risk. And the Bond Guarantee Program will make it possible for CDFIs to be takeout financing for the banks going forward, and it'll create a tremendously different dynamic. And we didn't know, for example, when we sat together 30 years ago, that one day, one Sunday night that I'll always remember, I got an email from someone I sort of knew at a company called Starbucks. Some of you are drinking their coffee right now, and that in the next 2 months we would create a program called Create Jobs for USA that had the marketing power and the brand power of Howard Schultz, who's a remarkable guy, and Starbucks, along with Google, along with Banana Republic, along with some other companies, that would raise money philanthropically, sort of crowdfund an effort to support CDFIs doing small business lending in their communities, a whole range of small business communities, by individuals giving $5 at a time. And we raised about $15 million, $5 at a time, that was able to support about $107 million of financing, more than 5,000 jobs created. And the point of Create Jobs for USA was not just that we could raise money. The point was to demonstrate that there were small businesses out there, lots of small businesses out there, and this was 2010, 2011, 2012, that were creditworthy, that deserved credit, that were going to do great things if they could only get access to credit. And we knew that, and we all sort of know that in some way, but it's sometimes hard to figure out how to turn that into action. And Create Jobs for USA was not an effort to solve the problem so much as to demonstrate that the problem could be solved, and that's a role that CDFIs play. CDFIs are often in the role of working just outside the margins of where conventional financial institutions can go, or where government can go in some instances, with two purposes. One is to create opportunities for the people in the communities that are outside the margin to enter the economic mainstream. But the other, and equally important, is help the folks who are working in the economic mainstream realize that these markets are opportunity markets, that there are people in their communities and there are businesses and there are residents and who, given access to credit, will do great things. And that is a key part of that, and we didn't know that. And we didn't know, and I say this not knowing what the experience is like here, but knowing what the experience is like nationally, watching what's happened in Ferguson over the past few weeks and the tragedy that it is. And we didn't know that, for example, that when President Obama announced back in March My Brother's Keeper, which was an initiative to encourage support for and financing of particularly Black and Latino male youth, but for all youth of color. We didn't know when that happened, and we saw that happen and thought that's what we do. that we would, as an industry that had $27 million as we sat in the room, would make a pledge that we would provide $1 billion a year of our financing, $1 billion a year to benefit youth of color. Of that, $300 million would go to male and Latino, Black and Latino male youth, and that we would commit to doing that forever. It wasn't a one-time thing, but that was something that we would recognize was sort of core to what we do. So we didn't know what that would be, and we didn't know what would happen. We didn't know, for example, that when the recession came, we worried about this a lot. When we first started borrowing money, and we borrowed money from a big supporter was the Ford Foundation. The Ford Foundation, through program-related investments, the Ford Foundation asked this question: well, what's going to happen to you? You need to be prepared. What's going to happen to you if the whole economy goes under, right? If the whole economy is a mess, if the global economy is a mess. And we sort of laughed at that, in part because we didn't have the experience. We all do now, but we didn't have the experience of what that could be like, and in part because we made the assumption, look, if things go really bad, we're out there on the edge. We're doing these things that are perceived to be incredibly risky. We believe that. We think that the risk is less than other people perceive it to be. And of course, if the economy goes bad, if, say, the housing market failed, that our institutions would fail, and they'd fail quickly. And in fact, in late 2008 and early 2009, I was part of meetings. I was organizing meetings with our investors that were planning. We thought 2009 might be our last year on Earth, right? This might be the end of it. But we didn't know, and we couldn't have known, that we were built, actually. We specialize in lending in difficult circumstances. That's what we do. That's our expertise. Jim Collins, the business writer, wrote Good to Great, has done some work with us, and it's been great. And he said that Cdfi, well, he used this example. He's a mountain climber, and he said that if you're climbing, Mount Everest and you get trapped at 27,000 feet in a snowstorm, and you've been training for it and you're acclimated to it, there's a chance you'll be fine, right? But if you're not used to it, you're dead. I mean, there's no either or. And he said, CDFIs live at 27,000 feet. That's the environment we operate in. We specialize in understanding risk and managing things that are different and non-conforming. And so we didn't know that we would come through the recession in a way that I can only tell you that the presidents of several large banks, several of the biggest banks in this country, most vocally Brian Moynihan from Bank of America will say, the CDFIs in our portfolio, and they have about $1.5 billion invested in CDFIs, CDFIs in our portfolio outperformed every other investment we have in the bank during the recession, right? We didn't do anything great. We didn't have big upside, right? Because we don't, we're generally below market. People think of that. But in fact, we're a little bit like, I often say that we're tortoises, not hares, right? And we don't do anything too dramatic and anything too fast, but we're slow and steady, and some of you remember the tortoise won the race. And so that's been the story of the recession. We didn't know that, and we didn't know that today, as I stand here, we've hit we started $27 million, we've hit a $50 billion asset figure in our industry, and we think that's just the beginning. We think that we're going to become a lot more important, and we're going to play a much bigger role going forward. But there's a reason we knew all that, and there are a couple things we knew, and I want to, as we sat in the room, and we didn't know much, we knew a couple of things. And the first thing we knew was at the time, most of that $27 million, not all of it, most of it came from orders of women religious, right? Nuns, primarily. And these women, and I don't know if you know how nuns manage their money, right? They pool their money, it's community money, and it pays for everything. It pays for their retirement, it pays for their care, it pays for health care, it pays for their food, it pays for their accommodations. And they are self-sufficient, they depend on it, and that's what, that's what they live on. And so the early money, the first money really in was the nuns' retirement money, right? Now there are a couple things you learn really quickly. Remember, we didn't have any equity, right? So there are a couple things you learn really quickly when you're borrowing the nuns' retirement money, right? First is you do something special with it. The nuns aren't taking a risk with their retirement and with their life and their ability to go on tomorrow so that you can invest in Fannie Mae, right? That's not what they're doing it for. They want you to do something that moves the margin, right? That's one. And the second thing is, under no circumstances ever do you lose the nuns' retirement money, ever, right? And I think that those two things defined who we were that day and who we are today, and it's the reason we've been able to achieve the things we've been able to achieve, and are in position to do more. And that is, one is that, mission, right? There's people think mission instead of Jim Collins is this lesson. Jim Collins thinks that if you took the return on investment in CDFIs over 25 or 30 years, they'd probably beat every financial institution in the world just as a return on investment. I haven't done the calculations, and we don't really have the data to do it, so I can say it. But But you know, it's an interesting notion that if you're doing mission and you're doing it steadily and you're doing it well, that in fact you can create great financial results as well as mission results. And the other is a culture of discipline in our industry. We are largely unregulated, non-depository institutions in the CDFI industry. We are across the country about 700 institutions. We work in all 50 states. My membership is about 250, and we self-select as sort of around performance, and so they're fairly highly productive and high-performing institutions. But we're in all 50 states, urban, rural, native communities. We finance housing of all sorts. We finance businesses of all sorts. We finance nonprofit businesses and commercial real estate that's nonprofit, for-profit, things like charter schools, for example, that I mentioned. And there's little that we won't do, and even as I stand here today, there are folks figuring out how to finance new things that we didn't know were possible. And we started with all that nuns retirement money, and we had a lot of faith-based money, and we still have a lot of faith-based money, but the fastest growing part of our capital is bank capital. And that comes about because we also didn't know when we sat there that along with the Cdfi Fund that would provide $1.5 billion so far, in equity to CDFIs were changes in the Community Reinvestment Act that made partnerships between banks and CRA productive, banks and CDFIs productive for the banks from a CRA perspective as well as a financial perspective. Remember Brian Moynihan, and were good for the communities that we were working in, and so those things were happening together. We are just really clear, just to be really brief about this, I said most of us are uninsured non-depository institutions, or loan funds as we call them. Loan funds might do housing lending, they might do microcredit, as Justine Peterson does. But they could be, you know, the structure is not so important, except that one of the things that's really important is if you're a well-capitalized institution and everything falls apart, like it did a few years ago around us, right? You have the equity to be able to do it. You have the ability to make the right decisions about how you treat your assets. If it's a troubled asset, you can book it as a troubled asset, and you can be aggressive about it because you have a balance sheet to do it, and you don't have regulators in the same way that banks do that constrain their ability, no matter what all of you individually and bankers all over the place want to be able to do. Sometimes the regulators don't let you do it. You may know the borrower. You may say, I know this is going to be okay. The regulators won't let you do it. Loan funds bring tremendous value in that. And so that bank investment in CDFIs, which is not exposing the bank to the underlying asset risk, but it really depends on the institution itself, the intermediary, the enterprise, the CDFI, to manage risk. And so it helps banks manage risk, and it helps banks get money into markets that are, one banker once called them undermarkets, because they grow into the markets for the bank. That the banks are trying to serve. But you know, CDFIs play multiple roles, and you'll have a chance to talk about that a little bit more in your sessions. And if I leave time for questions, you can ask me questions about it. But so the point of all that, right? The reason I wanted to tell you all that was not just to, maybe you're interested in my story. I don't know if you're interested in my story, but it's really the question I want to ask you is, what will you say 30 years from now, right? What will you think? Here's a beginning. Here's folks coming together, right? Metro East, sort of a new effort. There have been a lot of people sort of dabbling, trying to figure out things. There have been people doing great things that maybe we don't know about or I don't know about. But this is the beginning of something, right? And the question I have for you as you sit here, whether you're an entrepreneur or a banker or as with the SBA or with the CDFI or a community activist, is you know, what's the legacy? What's the thing that you want to come out of this as you look forward? And if you allow yourself to dream about what that is, you know, will it be that you came together to start a new movement in Metro East to support small businesses? Will it be that Metro East will become sort of the, you know, the unknown business capital of the world, of the nation? Will it be that banks discover new ways to use their balance sheets to create good for their communities while creating good for their shareholders? Will it be that the SBA brought you all together? I don't know what the answer to that is. I mean, that's your job. That's what you're here for today. And I actually want to tell you a story. It was actually one of the best stories. Ron got me started with stories, and I love to tell stories. But it's one of the best stories I ever heard at one of our conferences where folks come and share what their experiences are. And this was actually someone who was a micro-lender in India. And this was about 10 years ago. At a conference in Oakland, California, and he told the story of, you know, and they had a stall, really, not even a shop where they operated out of, And one Monday, or I guess it was a Monday, they showed up, and there was a woman across the street just looking at them and staring at them, and she didn't do anything all day, and they didn't know whether to go out to her and whether she wanted to come in or wanted to be invited in. They didn't know. So she was there all day Monday, and they talked about it and went about their business. And Tuesday, same thing. Wednesday, same thing. Thursday, finally they went out and they talked to her, and they said, are you interested in a microcredit? Would you like to come in and talk about that? And she said, yes, I would. And they brought her in, and they sat down, and they got to know her a little bit. And her story was that her husband had died, and she had 5 young kids, and she didn't know what she was going to do, and she didn't know how she was going to support them. And they said, well, what are your skills? And she said, I don't really know. I know how to cook, but I don't really know whether I have, whether I'm good at that or anything like that. And they said, all right. And they said, well, what we do is we lend money, and if we loaned you money to cook, what would you want to do? And she said, I don't know. I don't know how to do that. I don't know how to run a business. And they said, well, if we loaned you money, we'd have to have some collateral. She said, what's collateral? They explained to her what collateral. She said, I don't have anything. I can't do that. And they went through a whole series of questions, and she was very, very passive, but something told them she was very determined. And they said, finally they said to her, you don't know what you want to do. You need to do something. You don't know what you want to do. You don't have any ideas about how to run a business. We can help you a little bit, but you don't really have ideas, and we can't tell if you're really going to work at it. And you don't have any collateral, so if we make you a loan, it's really very risky, and we're concerned about that. And so we have to ask you, do you think we should make you a loan? And she said, I don't know. She said, that's your job. My job was to find the courage to come in here and to talk to you. And so I would say to you that that is your challenge as you sit here today, is to figure out, what do you want to make for Metro East? What do you want to make for your banks? What do you want to make for your businesses? What do you want to make for your community? And I obviously can't answer that. I only know that I've been hanging around with these CDFIs for a long time, who know that if you bring people together and you help them get organized, and you bring money together and help them get organized, and you allow yourself to dream and you have some vision, that you can create great things. And you can do good things for your community, for your neighbors, for the local economy. And before I wrap up and leave a little bit of time for questions, I actually want to talk a little bit about, from the national perspective, we are very intensely, at OFN, we're very intensely focused on what's going on in the small business credit market. This is supposed to be about access to credit, so I better talk about it a little bit. We're really focused on what's going on nationally, and we're really, really deeply concerned. Everybody knows that small business lending, and I mean small business lending under, say, $250,000, has really struggled, above that struggled for a while, but has really struggled, continues to struggle in this country. Some of you know that data from the SBA 7A program shows, particularly from 2007 to 2012, shows a really steep decline in lending to African American entrepreneurs. And by steep, I mean 80% decline in lending to African American entrepreneurs. We know that the SBA, in a good effort to try and get more small business lending going during the recession, doubled the cap on what it could do under the 7A program. And we know that financial institutions, acting rationally, tended to make larger loans rather than smaller loans, making the problem worse for smaller businesses who wanted smaller amounts of credit. We know that the SBA created the 7A program, 7A Community Advantage program, to encourage CDFIs and other mission-driven lenders, 504 lenders and others, to start using that program more to try and fill that gap in the credit market. We know that there are banks that are getting increasingly active in trying to get back into the small business market, and I don't know anything about your market and what's going on here, but I know that as a national trend. But the other thing that we know is that there is an emerging strategy for lending to small businesses. Some people call them alternative lenders. I don't like that term. I will call them new lenders. And they are predominantly online, not entirely. They are very aggressive in how they market. They are driven primarily by hedge fund and private equity capital that's seeking very high yield on investment. And they're growing incredibly quickly, and they are reaching businesses everywhere in this country, including, for those of you who are bankers in the room, your customers, whether you know it or not. in a way that in some cases can be good, and some of them are doing a good job, and some of them are not doing a good job. Some of them, I get in trouble for saying this, but I say often that there's a new class of predatory lender out there. And in fact, it's not even a new class, because one of the things we discovered, I'll just pick one, and it's my favorite one to pick on because it's an easy one to pick on. It's a company called World Business Lenders. Anybody ever hear of World Business Lenders? So primarily online. World Business Lenders has an average APR on their loans of about 150%. That seems a little high to me, right? But you wouldn't know it because they don't tell you it's APR, because there's no requirement. This isn't the mortgage business. There's no requirement to disclose your APR, right? So they tell you their interest rate. They may not tell you their interest rate is that's a daily interest rate. They'll tell you the interest rate, right? And they have deceptive, now, so 150% is a little scary, right? What really concerned me was I got a call once from a reporter at Business Week. I was telling folks at dinner about this last night. It was I think he was an intern. I'm not even sure he was like full-time reporter. But someone he knew had come in and shared with him all the training videos and the manuals and the things that this company had used to train their sales folks, and it was chilling. It was really absolutely chilling. And so he called me and asked me, I mean, it was things like algorithm, the credit algorithms really looked at sort of, if they loaned at this much, when would the business fail, and how do we get out at least 30 days before that, right? And how do we load on extra credit to folks, right? So it's that kind of stuff. But how do we use yield spread premiums, which are an old tool from the mortgage loan, not old tool, but used in the predatory mortgage business, where the brokers who are incented to bump up the price of the loan as much as they can, and they get compensated for it, where the brokers are making more money than the lender is on the transactions, right? These are all things that they're trying to do, and it's all a fight to gain market share in the small business space right now. So people are getting increasingly aggressive. And but as I was on the phone with this reporter, I said, geez, I've never heard of these folks. So I go looking up and I look at, well, okay, who's the CEO? And I look up who the CEO is. And then I Google him. It's easy to do when you're on the phone now. I Google him. It turns out, well, the story begins sort of, now that he's paid off all his fines for his predatory mortgage lending, so-and-so has started a new company in the small business space. And you start tracking these people, and it's the folks from the predatory mortgage lending space, a lot of them, not all of them. A lot of them come from there. The marketing people come from there, right? The strategists come from there. The systems come from there in some cases. And it is scary, not because there aren't good lenders out there. There's some great online lenders, and they're terrific. In the CDFI world, we're trying to figure out if we can offer some sort of an online alternative. And I don't know that we can. And the reason I can is some of you know Gresham's law, economics law, Gresham's law, bad money always chases good money out of the marketplace, right? People have heard of that. It's unfortunately true. It's what happened in the predatory mortgage space in some ways. And I think that the challenge that we think we have at OFN, we think we have in the CDFI industry, we think you have, is to try and figure out how to get good money to chase bad money out of the market. And I don't know the answer to that, because what's happening is this is driven by capital. This market's relatively small compared to the mortgage space. And what's happening is that some of the hedge funds and some of the private equity folks, a few of the venture capital folks, are dabbling in this space. And dabbling for them means, they put up $100 million, $200 million, $300 million, which is enough in this space to actually, stand up a company and make it, give it the resources to be pretty aggressive in the marketing space. And this space is really crowded now and there are many more coming with these aggressive, some predatory small business lenders. And for those of you who are lenders and are lending to small businesses, I would encourage you to sit down with your borrowers and look at their bank statements. You may know them, they may be in your banks, right? But really go through them, because what we're discovering a lot of is, unlike the mortgage business where if you take a second mortgage, it's complicated and there are all these legal constraints on what you can do and who you got to notify and everything like that. That's not true in the small business space. And what you charge isn't disclosed in the same way in the small business space. And so what we're seeing are businesses that come in, and these are often in the till loans, right? These are loans that come out before the business owner even gets to touch the cash. And what we're discovering is not that they have one loan from a company like a World Business Lenders or some other companies, but that they have 2 loans or 3 loans or 4 loans, right? And so they're layered. And so guess what? That business isn't going to make it. If you have 3 or 4 loans stacked like this at that kind of rate, your business is your loan's in trouble. And if you see World Business Lenders in there and they have different names that they draw, through ACH that they draw out on, you beware, right? It's that kind of a situation, and it's happening fast, and it's happening everywhere. And so I don't know that it's happening in Metro East, but I'm willing to bet that it's happening in Metro East. And I think that that battle in the small business space is going to be really critical. The challenge is, we've talked to folks at the SBA about it. The SBA folks recognize it. They understand the problem. They have no statutory authority to do this. Nobody really has any statutory authority to try and rein this in. So I think it's only a matter of time, whether it's 3 years or 5 years or 7 years, depending on how hard they fight, before there's some sort of regulation of this business. But in the meantime, beware. In the meantime, if you're in the small business space, if you're a small business entrepreneur, be really careful about this. If you're a small business entrepreneur, you're doing everything you can just to make your business work and maximize what you're doing, and you don't have a lot of time. And so you tend to make these credit decisions really quickly. And these guys and gals are really good at selling what they got, and so it's an area to be really aware of and really careful about. So I offer that to you as a caution and as a challenge. There's a lot going on to try to combat that, but it's going to be tough to stop it. And I think that there's a lot of energy, but it's going to have to happen locally, and it's going to have to happen one business at a time. But the real meaning here, from my perspective, is that you're here together now, and you're here sitting in a room together. You'll as Ron said, you'll sort of step across the aisle of the bus, and you'll talk to somebody, and you'll learn something, and you'll make connections. And out of this, something will come, and something great, I hope, will come. And as I said, when we sat together under the apple trees, I wasn't there. I'm way too young for that. No, when folks sat together under the apple trees in Waltham, Massachusetts, one of the things they had was this willingness to try to work together, the willingness to try and combine their efforts into something bigger or better than any one of them alone could do.